Hello, everyone, and thank you very much for joining us for the Nasdaq Dorsey Wright podcast on this Wednesday, May 6th.
My name is Ian Saunders, and I'm joined here by Eric McCardle and Steve Raymond.
First podcast that we have here in the month of May, and with the month of May brings about the evaluation of the change in seasonality, rather, with the market. As you may be familiar with the old market adage, to sell in May and go away. We have some models on the platform that try to take advantage of some of that seasonality. So for the majority of the time here today, we're going to be focusing on some of those models, the FSM, the fund score method-based models, which are evaluated on a quarterly basis, but try to capture that seasonality by looking at seasonal quarters. So these models are going to be evaluated at the beginning of the month, February, May, August, and November. And so we saw that this latest model evaluation occurred after market closed on Monday, with the trades coming out there yesterday morning. And we saw changes here to many of the models, but not all of the models. Is that right there?
It is, and I think that's one of the most important points to kick this off, Ian, is that some of the changes that didn't happen actually speak to really where the strength is in the market and what has continued through this last seasonal quarter, which has been quite tumultuous, right? We've had this COVID outbreak where the world looks entirely different than it did at our last update in February. And so, in that vein, if we start with our core solution models, which are going to be looking at inventories of ETFs, predominantly core-based, with a focus on domestic equities for the U.S. core, and a focus on size and style factor exposure, as well as the ability to go international for the all-cap world model. Neither of those two holding models saw an update with this turn, which is really interesting, right? And if we look under the hood at the all-cap world model, which again is going to be the more granular of the two, our current holdings maintained through and through with JKE, so the iShares Morningstar Large Growth ETF, and the Invesco QQQ Trust. And so, that again is more of a continuation of the growth theme dominating equity markets that we've really seen play as the primary narrative here for a couple of years now, right? And so the continuation of that holding steady with those model holdings has done well for the model, right? We see on the year model is just in the black relative to an all-cap world benchmark that's down about 15%. So a lot of strength and resilience among those holdings. And pivoting to the U.S. version, which is going to be a little bit more bare bones in terms of the inventory, and of course only staying within domestic equities, we see a similar posture in the Qs, but also focus on momentum via MTUM. So again, I think just, really noteworthy in saying, okay, we've had a lot of change here in terms of, some of the sector strength, some of just the overall tone and risk markets over the past few months, but the core solution models really haven't budged.
Let me jump in and say that the, kind of one of those types of market turbulences, some of those forms that we see them show up in, sometimes the market does change its preferences, like just large cap towards small cap, or an extreme growth towards value. And you see this shuffling around of kind of not so much the sectors, but in the asset classes or the style boxes. And then many market corrections or bear markets, show that the market has not changed its preferences. And I think this is a good example of a very turbulent market, but the market's preferences concerning the major style boxes or asset classes remained pretty consistent. And so these models, the core solution, U.S. core, the all cap world, are designed, the inventory is designed in such a way as to kind of stick with the main, the main building block, and not have so many choices in the inventory that it drifts into, let's say, too many style boxes or peripheral of the inventory, but rather, stay focused on, these important building blocks. And this is one of those markets where you see that the large growth and the the core-based S&P 500 type funds have been the ones that we've stuck with really all the way from the whole year, and certainly no change since February. Keep in mind that the models are designed to through the scores to change if changes are needed, and in this case in these inventories we're right on the target of large cap US. Back to you, Hare.
Yeah, well said. And so, with that theme where we've seen the growth story remain dominant, we've seen technology remain the dominant sector. We've also seen, more of an offensive posture within one of our go anywhere models, as we put it, the T. Rowe Price lineup. Ian, do you want to share with us some observations from that model change?
Yeah, absolutely. So, I think a lot of the themes that we see, this consistency of the large cap space, as Eric and Steve talked about there, we did see that reflected in many of the changes, and there were quite a few changes for the T. Rowe Price model that we have there. Again, this model is a little bit different, looking at 5 holdings instead of just 2 holdings like those core solutions models. So we saw this model actually sold out of 4 positions there, then moved into a communications technology. And then it had some the large cap areas in there as well. Blue chip growth, health sciences came into the portfolio as well, with general kind of rise and strength that we've seen in healthcare on the backs of this global health crisis that we have. And it was interesting to see global stock come into the portfolio as well. So one of the models there that saw a fair amount of rotation, but it does speak to the flexibility of the portfolio. It does kind of take advantage of trends that we're seeing going on in the market. And here we see that those large cap growth dominated trends are being displayed here in these portfolio changes as well.
An interesting point to make, Ian, is the T. Rowe management. They really know how to focus down on the areas that they believe are the right ones. And quite frankly, you don't see a lot of non-US at all in many of our models be able to make it into the tops of the inventory. So really it's quite comforting that you have pretty accurate managers that know what they're doing, and so we're starting to see some of those global stocks come in, believe it or not. And I think it's encouraging that they're able to dip in that space and make something happen there, and that may grow. It could be that we see in future quarters the T. Rowe managers pick up some of these decimated non-US areas to a greater degree, and I think that would benefit them. And I think that they already know that because some of their non-US funds are some of the best long-term performing non-US funds we've seen from the active manager universe. So I think this could be chapter 1 of the idea of starting to dip a little bit into the global stock scene, probably a toe dip here, but that, it is interesting to see, and certainly a good story to tell your clients that that we've got some good updates, and their stories anchored in the US, but we got some really good managers that are starting to toe dip around in other areas, and that's part of why we do change the model. In other words, we update the model multiple times a year, 4 times a year as a standard rhythm, and part of that is the reason to pick up on some of these minute changes that can be very helpful, as those quarters stitch together long term. Back to you, Ian.
Yeah, and I think the important thing to keep in mind here is that as Eric mentioned, these models, this is one of the more flexible models that we have here in the FSM suite. The universe is comprised of not only equity-related areas, but also has some potential exposure to fixed income and other areas in there as well. So it was definitely interesting to see the global stock portfolio, the global stock fund come into the model, but it was also interesting to see that even with the risk-off mindset that we had for most of at least the end of the first quarter, into the seasonal quarter here, that we saw the management from T. Rowe allow these stock-focused funds to rise back to the top of the score rankings so quickly that we didn't have the more fixed income related areas hanging around, that we're able to get back onto the risk-on environment, at least as dictated here by this T. Rowe lineup.
Yeah, I was just going to add, and I think you both have touched on this in a way, in saying, one of the benefits of this active management process being able to have refined exposure into those areas where a passive index approach may not do as well. And so, it kind of just solidifies our philosophy behind this model lineup, not only from T. Rowe, but also from the other offerings that we're going to go through today, in pairing together, right, and being able to offer complementary strategies, to one another. So over to you, Steve.
Well, I just wanted to draw from some historical experience, which is not obvious, for advisors in these days. They don't remember sometimes that in past market turbulent zones, that the managers you counted on stopped doing what they did so well. I'll reference back to a market collapse back in 99 through 2000 and through 2001, where certain focus managers in those days, I don't really need to name the name at this point, but you would know it if I said it, that they were very focused on the way up, but the market was so severe on the way down that they actually changed their investment philosophy. And they did so what now in retrospect looked like, a bottom of a market. So they really left people hanging on this, recovery process. And I think Ian made a great point where, look how T. Rowe has, suffered like the rest of us, like the rest of the world, with incredible turbulent markets, but they stuck to their investment theme, which is to be, some of the best focused managers on the street. They stuck with it, and again, didn't abort that mission and try to do something else. And I think that we're really appreciative of managers that, stick with their discipline. That's why we use them. In other words, you could say that's why we hired them to be involved in an abstract way, to say we want the best cultures and managers that do what they do best, and we count on them to do it. We count on them to be to do their style, and I think T. Rowe's done as Ian pointed out, an incredible job, to take the hit along with the rest of the world and yet snap back as expected. You shouldn't presume that every manager out there has that gift of sticking with their discipline, but I just wanted to shout out that T. Rowe has definitely done that here. Back to you.
Yeah, and further on that, one of the, of course, the shop culture and the investment philosophy and track record is so important in how we design these inventories and models. But at the end of the day, the other thing to remember is relative strength is ultimately holding these funds accountable, right? And so whether or not the manager is let's say competent or proactive about their decision making, that's where our methodology and our research are always there as a backstop in determining strength and weakness. So just kind of, as one may say, playing the piano with both hands in a sense, where we're able to pair different types of research and different types of security selection into one coherent strategy. So with that, we can pivot over to another Go Anywhere model that saw a few changes. This time we're looking at the First Trust ETF lineup, and we did see very similar changes here. We had a shift primarily among equity funds, right? So another offensive posture. Same idea as the T. Rowe inventory, where we're looking at kind of a growth focus, a diverse inventory and lineup of different ETFs that give you the ability to go into different asset classes. But if you are, predominantly looking at the ETFs versus the mutual funds, this First Trust model is a terrific one for you there. And of course, we see similar themes echoed with a focus on biotechnology and healthcare, as well as technology in general with the internet up here. And we mentioned in the report recently, FDN actually moving to all-time highs as of late. So, a lot of strength there within technology, which has, of course, been a dominant theme, leading up into this market environment and continuing throughout the other side.
Certainly there, Eric. And another point to mention on here is looking towards the technology in the healthcare space. So we've seen continue to kind of lead the way, as you mentioned, and looking at the sector exposure of the underlying holdings of the funds that we had here in this model. I mean, we see a very, very vast overweight towards those two particular sectors, with 40% exposure in both technology and healthcare, making up over 80% of the portfolio in and of itself. Definitely looking towards those two areas to kind of continue to take the at least the equity space forward here as we continue down the next seasonal quarter.
Yeah, and let me point out that this model again, First Trust is very in the ETF realm. They are masters of focus, where they run a great shop, and their inventory is generally what I call hotter, which means a little bit higher beta type inventories. And some may say when I say that, they step back a little bit and say, oh well, we don't know if we want to get hot right here in this kind of market, but that's why we work with them, because they do this culture of high focus very well. I will point out that that model's picked up some mid cap exposure. So I, just to break the ice and saying that not everything is just a 100% large cap, and the equity portion of the models that we've seen, which is pretty interesting to see. But it also follows that there's not much small cap, just like we don't see small cap as a major asset class in relative strength in this portion of the episode with the market. But be assured that T. Rowe is an excellent small cap manager, and if need be, as the months and quarters go by, we'll be able to address that asset class. But for now, I would say that there's almost no trace of small cap in kind of that First Trust high relative strength universe. And quite frankly, with our independent research we also do, we don't see any reason to be in small caps either. So it's kind of a one supports the other as you tell your story to your clients, why you're where you are and why you aren't where you aren't. And as you can see, the T. Rowe management and the Dorsey Wright research, it's kind of hand in hand here, but both independently saying the same things, which is kind of comforting to build that storyline as you approach your clients to tell the story. As they're starting to open up their statements, one or two statements have gone through here possibly. It's time to talk to them. Not only is it time to talk to them, but time talking about these new model updates, which are so fantastic. Here, touch base with your clients and say, hey, here's what we're doing. Here's the activity. Here's what we're involved with, and here's some storylines that you can pass on to your clients. Back to you.
Absolutely. And I think you hit the nail on the head there, Steve, with that. This is, as you mentioned initially there, that this is going to be one of the more risk on the hotter models that we had there with that First Trust model. So for those of you who are looking more towards maybe a more defensively minded portfolio, and maybe not something as hot or as risk on as some of these initial models that we were taking a look at, we pointed in the direction of the American funds model that we have, the American funds FSM model that we have. Again, going to be a flexible inventory looking at equity and fixed income names in that potential universe. And we saw, as of the most recent evaluation, there were 3 changes to the American funds 5S model there. And it's now going to be overweight towards fixed income at 60% of the portfolio, and then the remaining 40% there taken into domestic equity. But definitely an interesting differential to see with the different providers, with different managers there, seeing that more risk-off approach coming from the American fund space as these fixed income related funds continue to score relatively higher among the model universe there.
Yeah, no doubt about it. In fact, keep in mind that, one of the reasons, or primary reason we want to, 2 reasons we want to work with American funds is they stick with what they do. They stick with what they do best. And that is more of a conservative nature in general. That's true with their fixed income and equity pieces. They're what I call over-diversified. I use that term in a good way. And probably the best over-diversified types of managers that we'll ever run across. So they definitely complement the other types of models that we do, and they definitely work great as a standalone model to work with what I call the general high net worth clientele around the world, which usually have some age to us, and we're not up for the roller coaster ride in the sharpest way that we can find. Sometimes we're quite fine, building that wealth building is the American funds culture. I wanted to make a note, before we move on to other commentary, is that American Funds also raises cash inside their funds. In general, T. Rowe does not do this, but American Funds does raise cash as they, as their, team management decides that they need to raise some cash. And so many of their equity funds have slivers of some, 10 or 15% cash in them as we floated in from March into April. And that slowed down some of the scoring on the equity funds. So I just wanted to make that point that as they got more conservative in their equity funds, it slowed down the scores. And of course, their fixed income funds are actually some of the highest scoring funds in the entire inventory. And I just wanted to make sure that I made a point that, well, part of this is by the function of how American Funds runs money. And I think that's important to note. On the top line, though, it's the conservative management style. And I think it works very well with as a standalone or as a complement to other models that you would choose. Back to you.
Absolutely. I want to throw one comment in there, Steve, because you made a good point about how they manage their portfolios. And, one of the things that I'm really fond about regarding Capital Group is the transparency of their bond portfolio, right? When they put a bond portfolio together, they're looking for exposure that's going to play as you would expect and not really throw a whole lot of rocket fuel on the mix. And I respect that in a bond manager. So when you see these moves, and as you pointed out, within that universe, the three top scoring funds right now are the three bond funds that are included. You know what you're getting in terms of that bond exposure. And I think that's especially now more important than ever as we go through a really turbulent period in not only the equity market, of course, but also in the bond market, and making sure that your fixed income exposure is going to behave as you would expect.
I think it's important to back up what you said, Eric, because in 2008, in that dilemma, we still use the same American funds, but they're still the most wonderful family, doing the same thing that they're doing here, the same thing they've always done. And I will say that in 2008, we faced a crisis with not only equity, as many people remember, but we actually faced a crisis with bond funds. And various shops that I won't name here, but do have big names, had very well-respected bond funds. And many of them fell prey to that 2008 market and plunged far beyond anyone's expectation and sent a shock through that market of how unstable what would otherwise be a trusted core bond fund. American funds, however, held up beautifully. Absolutely beautifully, with their management style in that vein. And I think, Eric, to bolster the point, is that's what we need. We didn't know we needed that in 2020, but we certainly needed it. We found out we needed it, and so we're very thankful that American Funds sticks with their management style and delivers the type of portfolio that we need, and we got them. And of course, FSM's rotated in between the monthly and the seasonal models. The monthly models have been rotating into the fixed income. The seasonal models have done so here. And I think that's comforting that we're actually using funds that have been tried and tested in real historical markets that were there and have shown to hold up very, very well in this what you would call incredibly turbulent market. So I think that's a good point, Eric. Back to you.
Yeah, and it does mirror the asset class group scores in a way too, right? Where we see fixed income remaining at the top of the rankings for the all group section when we expand to view the 135 that are publicly displayed on the Nasdaq Dorsey Wright platform. Bond funds are holding their own extremely well, right? And we've seen that in other indicators across the site. So this is kind of an interesting picture that translates over to what those indicators and what those scores are showing elsewhere. And if we shift over to another inventory and another model within the FSM lineup with the Vanguard 5S model, we see a similar posture here where fixed income has made the presence known within the model holdings upon that seasonal turn. Any observations on that front of you?
Yeah, absolutely. I think it's interesting to note here. So with this model, we saw three new funds come into the portfolio. There, as Eric mentioned, we had two bond funds coming in, and then we also had the addition of healthcare as well, kind of continuing that strength of healthcare that we've seen. Which, as Eric touched on, when you're looking at the asset class group scores page, some of the areas that we've seen rise in strength on that page over the past couple months have been healthcare and bonds, and so we see that reflected here in the Vanguard model. Again, the flexible nature of the model really coming to light here. Looking at the 60-40 split currently between 60% equities in this case, the reverse of American bonds. So 60% equities here with the Vanguard model, and then 40% exposure there in bonds. Going to be rounding out the equity exposure with healthcare, and then two growth-focused funds there, and then looking at a Vanguard Total Bond Market Index, and then as well as a government bond fund, giving you the more kind of moderate approach, I guess, if you will. If you consider the fully equity as maybe the more aggressive, you have the American funds a little bit more conservative, as Steve said, and then here we have Vanguard coming in here, and their score lineup is indicating a more moderate path here going forward.
Yeah, in fact, that's kind of why we use Vanguard, because they really fill out a bell curve of all these asset choices available. They have a massive inventory per se, but we really don't count on them for active management because they really don't provide much active management. We count on them for the ability to get exposure, to definitive known asset classes and let that relative strength, play out, over the months and quarters. And I think it's a good complement to the other active managers. Keep in mind that there are years when non-active management seems to do very well. There are years where active managers, seem to be the only thing that works. And so, what we do in the FSM, catalog is make sure that we're, paying attention to those different types of cultures. And so I do encourage, working with active managers. I do encourage working with our focus inventories that we put together, but certainly Vanguard plays very well as a mix with those other models, in that basically there's not a lot of active management, but there's just active relative strength work, that makes sure that you're paying attention to those, other broad themes in the market. I think that proves helpful, and it gives a good anchor to the portfolio. Back to you.
And when you're looking at that kind of anchor there, as you mentioned, I mean, any kind of fully invested portfolio, probably going to be looking to have exposure towards other areas that might not necessarily just be equity focused. Maybe you want to have that kind of core exposure to some fixed income aspect as well. And so we have those. We have fixed income related models that are specific to the FSM lineups here too. Looking specifically there at the FSM PIMCO All Asset and the FSM Franklin Fixed Income, both looking at their respective inventories of fixed income related funds from those two managers, and applying that fund score approach. It was interesting that we saw in both of those models, both of those seasonal models there, both of those models had two changes, and we saw government securities funds being purchased in each of those respective models there. So kind of in line with the government approach that we see from Vanguard, we see that reflected in the more fixed income focused models here too.
That's right. And so within the fixed income space, of course, that government trend still being intact from a relative strength standpoint, we've seen a little bit of a tilt away from risk within not only the fixed income scores, but of course, as a reflection of these model inventories, in moving out of, again, the risk assets such as convertibles or preferreds, or especially high yield, right? We noticed that all three of those are absent in our primarily fixed income models. So, again, I think just an important point to touch on here is that within your fixed income exposure, you want to definitely know what you own right now. And, these models do a nice job of labeling that as such.
In Franklin, one of the reasons we love that shop is they really run fixed income in more of a classic manner, which, advisors that have been in the markets for, some 10, 20, 30 years, 40 years, 50 years in some cases, that classic way of running fixed income and having more of a transparent, underneath the hood understanding of how that fixed income is run. Franklin's one of the best fixed income desks out there. And I think that we rely on that for, pretty straightforward fixed income. And here it shows that we've moved into a pretty conservative nature, both last month and this quarter. And I think, that's what the relative strength is telling us to do. And of course, the ability to go back to other, higher risk fixed income assets is certainly doable. But again, in the seasonally weak cycle of the market, I think this is kind of a pretty good move. I think we'll find, and very complementary to other asset approaches that you would be mixing in, like for example, T. Rowe Price, American funds. Franklin plays very well with those models as that piece that helps you build out a strategic piece by implementing a fixed income model with your other models that can do various things. Back to you.
And one way that we see that potential implementation, the kind of combining of these different models reflected is through a model of models that we actually have here on the platform readily available. We call the FSM Tortoise and Hare model, which is looking at essentially combining many of these different models together into one single model that we have there on the platform, looking at exposure in the U.S. core solution model, as well as the all cap world. You have American funds in there as well as T. Rowe, and then the Franklin fixed income model that we just touched on is going to have exposure in that portfolio too. The Vanguard bond market is going to wrap that up. This model is geared towards the Tortoise and Hare 80-20. You're always going to have a 20% invested in fixed income and 20% invested in equity. And the remainder is going to be flexible in terms of where we see that allocation go as dictated by the models. And so interestingly enough, we see that with these model updates, we've seen that exposure change a little bit, moving more towards more of that moderate approach. We have right now model still slightly overweight towards equity at just over 50%, but we still have about 40% exposure to fixed income now with these recent changes. So seeing a little bit more of that moderate move going forward when you're looking to bring many of these portfolios together in one format.
That's right, Ian. And the beautiful nature of combining these models together is that they're independent pieces. They're slightly or significantly different inventories and significantly different cultures behind those inventories. Leads to kind of that sourcing the crowds, sourcing all the disciplines and the strategies to see how to address the current market that we're in. I just think it's absolutely fantastic that we moved from an 80-20, we moved in some sense to a 60-40 ish type of moderate allocation, and it's all done for you. You didn't have to make that call. You didn't have to sweat that one out. It just did it because basically you're working with several sub strategies. As they blended together, they pointed into a new direction, which was more conservative. So I think it's a very active way to say my strategy. I follow my strategy, but it changes the guideposts, changes the strategic allocation, as the months and quarters go by, and that's an incredible benefit to the advisor using this, allowing him to address the market, but address it in a pretty sophisticated way, but not complicated way. Because what you're really doing is you're allowing the relative strength from Dorsey Wright, but really singing through the American funds and the T. Rowe, and in some sense Vanguard and Franklin, and certainly in a great sense the core and all cap world type of approaches that we do through ETFs. It gives you a blend of mutual funds and ETFs, and it also gives you a pretty smart and sophisticated way to produce a strategic allocation for your client, which I just think is a very valuable tool for you to consider. I do know that speaking to a lot of advisors, they're not aware that we run a master model called Tortoise and Hare, and so this is a good podcast to highlight that. Keep in mind some of the naming of the model is really my fault, where I said, we ought to combine, the good old Tortoise, which has really been more of the American funds and Franklin shops, which are always there. They're applying, a good diversity in their mix, and then for the Hare, or you could say the Jackrabbit, that focus approach, that putting down the gas pedal, making the car go a little faster approach. Of course, T. Rowe Price, is known on the street as that kind of manager. And so, combining the Tortoise and the Hare, rather than viewing them as a tortoise over there and a hare over here, combining them is very complementary, where the whole unit will speed up or slow down based on market conditions, but you're still carrying along every bit of that active management and that relative strength active management all along the way. Back to you.
Absolutely. And I think, if nothing else, Steve and Ian, it provides a framework for how to conceptualize putting the FSM models together. You can use this single master model that we've put out there in the form of the Tortoise and Hare. You can use that effectively, or you can use it again as a guide to say, maybe I want to have a little bit more, core ETF exposure, or maybe I don't need, 2 different active managers within my mix. That's all good. That's the beauty of this, is that we've given you the building blocks to build out effective and scalable portfolios that you can manage across a book of business, and feel confident in your process in doing so. So, I think that kind of brings us to a good wrap-up point for our quarterly FSM model update. And we've seen a lot of changes, as we mentioned, right? Overall, a risk-on approach, but still a little bit of defensiveness in the market for some of these models, with that master model concept showing more of that moderate view. So, all we can do at this point is follow where the relative strength dictates, but we're fortunate that we have a process in helping us do that. And so for you all at home, if you're watching or listening and you have any questions regarding these concepts, feel free to give us a call. Our number is 804-320-8511, or drop us a line at dwa@dorseywright.com. And just let us know if you have any questions about any of the things we've talked about today. We're always interested in finding ways to incorporate this into your investment process. And we feel highly confident that in doing so, you will have a better time in the markets. So with that, Ian, Steve, always a pleasure. For you all at home, thank you for joining us. We'll talk to you next week.